Good afternoon and welcome to this ACT webinar on managing working capital and the opportunities and challenges for 2017. I'm James Lockyer, Development Director here at the ACT, and just before we start, I'll quickly explain some technical points about our webinar setup. There's a menu bar across the bottom that allows you to open various windows, and you can move these around your screen, resize them, or minimize them. The yellow button with a question mark is for help if you have any technical difficulties, and the purple Q&A widget opens a new window, and you can send questions to us by typing in the window. Please don't wait until the end to send in your questions. Send them in as they occur to you, and we'll deal with them at the end of the presentations, and we won't disclose any names. Finally, on the right-hand side, there's a green button which enables you to access some supporting documents which have been uploaded in connection with this particular webinar. I should add that a recording of the webinar will be available on the ACT website in 2 days' time, along with a separate copy of the slides. We're delighted to have speakers from NatWest and Infometer, who combine substantial experience in the practicalities of developing and delivering working capital optimization solutions. NatWest have sponsored today's webinar, and on behalf of us all, I'd like to thank them for that support. And this webinar is in some ways a follow-up to the ACT's recent successful conference discussing innovation and evolution of best practice in working capital optimization. And I'm sure we'll be picking up some of the issues that emerged from that event. Effective management, control of working capital, and its direct impact on cash and liquidity are increasingly important to businesses. There's a lot going on, and today we'll be hearing from a highly experienced team. They include Stephen Boyle, who's Chief Economist at NatWest. He's also a Director of the bank's main pension fund, Trustee of the David Hume Institute, and a member of the Policy Committee of the Centre for the Economic Performance at the London School of Economics. Also Rowan, Head of Trade and Supply Chain Finance Product at NatWest. He's responsible for working with all elements of the bank's extensive SME and multinational corporate customer base. He's an ACT member, and his career has spanned a variety of major banks across 4 continents. Brian Shanahan of Infometer assists companies in the areas of working capital and procurement, and Brian has worked with over 200 clients in 37 countries across 4 continents again. And he's also written some books on the subject which are available from Amazon. And finally in the team, Richard Crook, Head of Innovation and Engineering, and he leads a team of engineers and innovators looking at emerging technologies and their application across the bank to reduce costs, gain efficiency, and better customer experiences. His current focus is on the application of distributed ledger technology, including blockchain, across NatWest and RBS. In a moment, to start, Stephen will provide the economic backdrop. Rowan will then share his thoughts on the working capital landscape. Brian will chip in with some commentary around the corporate and user context. And then Richard will give us some comments on the technical backdrop. We're deliberately keeping the discussion short, so please get your questions in because we want to maximize the opportunity for discussion at the end of the formal sort of presentation area. Right, that's enough for me. So I'll now hand over to Stephen to give us some of the economic backdrop to working capital management. Stephen, over to you.
Thanks very much indeed, James. Good afternoon, ladies and gentlemen. I'm going to divide my remarks into 3 parts today. First, I want to reflect on the year that's now coming to an end. I'll then move on specifically to consider prospects for interest rates, and then I'll conclude with some reflections on important international developments that could influence outcomes in 2017. Starting with the year that's about to finish, it's been a decent year for the United Kingdom. We've been growing at close to our average of the last 40 years, so it's decent growth. The number of people in work is about 500,000 higher today than it was 12 months ago. The unemployment rate's below 5% for the first time in well over a decade. Corporate profitability is close to its highest level in more than 20 years. Retail sales are growing strongly, in part because wages have been growing faster than prices, and house prices, if anything, are growing a little too quickly. So it's been a decent year, and it's been a decent year of growth and performance, but with very low inflation. And that very low inflation, at least in the moment, has reinforced the case for low interest rates. Now, of course, the Bank of England cut interest rates in August in response to concerns about the vote to leave the European Union. But interest rates are low for more than reasons of low inflation or concerns about growth when we leave the European Union. Rates are low and will remain low because of a long-running structural slowdown in growth in all advanced economies, which has spanned 3 decades now. Rates will be low because this is a world that wants to save more than it has done in the past. The continuing expansion of the global labour supply means that there are more people now saving for retirement across the globe. And of course, rising income inequality in many parts of the world means increased saving because those of us who are better off save more than those who are not. And finally, this is a world that needs to spend less on capital services because of falling capital goods prices. So a combination of slower growth, rising savings, and need to spend less on investment are bearing down on interest rates in a structural way. If we believe what markets tell us, then it's at least 2 years from now before bank rate starts to rise again. And rates are likely to remain where they are in the UK, even as inflationary pressure builds in the course of next year, because of course the main economic event of this year has been the decline in the value of sterling, which is down around about 10% since the start of the year and more than 5% since the referendum. That will see inflation start to build for consumers as we move through 2017, and if we were to gather again at this time next year, consumer price inflation in the UK we would likely find running at somewhere between 2.5% and 3.5%. So what else can we look forward to in 2017? I have absolutely no special insights whatsoever on what the change of administration in the United States might bring, but I'd highlight 2 things, one of which I think is reasonably certain and the other of which is more important but more speculative. The point which is of greater certainty is that a fiscal stimulus is on its way from the United States, both higher spending to fund infrastructure programs, but also lower taxes. Given that the US economy is operating at pretty close to full employment, that fiscal stimulus will lead to higher inflation and to higher interest rates. We're likely to see a rate rise in the States next week, but that fiscal stimulus will mean rates rising faster and further than we otherwise would have expected as the Fed responds to that stimulus. The more uncertain issue is perhaps the more important one, and that is what happens with respect to trade. The intention not to go ahead with the Trans-Pacific Partnership is inconsequential as it's a relatively minor trade deal for the US. More important would be if the government there declares China to be a currency manipulator and starts to implement punitive tariffs. Finally, looking to Europe, the euro, as we know, is incomplete and unfinished business. A year ago, the European elites were telling us that it would take 10 years to put together a fiscal union that would underpin the euro. The chances of that happening today look much longer than they were this time last year. Therefore, the euro will remain weak and prone to regular bouts of crisis and uncertainty. That's what I'd like to finish on, ladies and gentlemen. I'd like now to hand back to James.
Thanks very much, Stephen. I will hand straight over to Rowan to look at the way the bank and its product suite is developing in the working capital area.
Great, thanks James. I'm going to touch on three broad themes which will hopefully oil the wheels of discussion today and set the scene of the working capital landscape and how we're seeing changes of the current environment. First, I'm going to expand on some of Stephen's comments on lower for longer. Then I'm going to talk about the challenges of managing working capital in a low-rate environment. And then last, I'm going to talk about how we're seeing the working capital environment change. So first, the new normal of low growth rates and lower for longer. And this is obviously the dominant theme is in the working capital landscape. And as Stephen pointed out, there are sort of structural changes, and some commentators are even suggesting that lower for longer could even be lower forever. Now, lower for longer obviously has a profound effect on the banking sector. And in a low-rate environment, banks have an increasing struggle to generate sustainable profitability. The key issue here is that without healthy banks that are able to generate sustainable returns and build capital internally, the economies will struggle to prosper. What we're seeing across the banking sector is that returns on equity are under serious pressure. The FT reported last week on the back of the stress test that across the 7 largest UK banks, ROE stands at about 2.5%, which is obviously a serious challenge to the viability of the business as a whole. And this means that banks are focusing heavily on cost as one lever of profitability that can be influenced. Now, this is a trend at a sector level, but in terms of working capital, it's important to recognise how it's actually feeding through to behaviour towards customers. Ultimately, banks are becoming much more active in managing relationships for value, much more difficult to sustain and justify sub-hurdle rate lending in a capital-constrained environment. Now, that said, I'm going to contradict myself slightly, because what we're still seeing is loan markets at relatively historic lows caused by the excess of liquidity from QE and also high levels of competition. And some treasurers have been very keen to use the opportunity to lock in liquidity at low rates. This is a theme that's been very common and something we've seen over the past few years. But post-Brexit and Trump, in an increasingly uncertain world, we've seen sort of a greater tendency for treasurers to look to lock in liquidity, sometimes for expansionary purposes, for working capital, but often defensively. And the trend has often been to look at defensive mechanisms to sustain an uncertain future. In terms of managing liquidity risk, most treasurers will be acutely aware of this, given that running out of cash is a cardinal sin of the industry. But reliance on uncommitted short-term funding is a high-risk strategy in this current environment, as some of the commodity traders found out that uncommitted funding can form a core part of their working capital. Also, with lower for longer, we're seeing the risk of rates entering negative territory, already happening in the Eurozone and elsewhere. And this could turn working capital on its head, because rather than maximising cash, it could be more beneficial to leave cash with buyers and lock it up in stock, which would lead to a rather topsy-turvy world. Which brings me to the second theme, which is managing working capital in a low-rate environment, because logically, from a purely economic perspective, focusing on working capital management should be more advantageous when rates are high, because if you tighten your working capital management, you can reduce high-cost debt and maximise the cash you're holding in high-yield investments. And invariably, corporate attention tends to focus on top-line growth in high-rate environments, and delivering working capital efficiency can easily be forgotten and prioritised. Temptation can be to build stock in anticipation of growing order books, to give more generous payment terms to customers, and to shorten payment terms to suppliers. But ultimately, managing working capital is so critical in a low-rate environment, because in the belt-tightening times of low growth, more attention can be given to incremental and marginal gains, and in putting the right foundations in place for the future. It's about delivering good discipline, and when rates rise, you've been in a good position to take advantage of that. So I saw a good example a fortnight ago at the ACT conference when a lot of our discussion was focused around how we're seeing treasurers and the finance department becoming much more focused on working capital and actually becoming a core part of individuals' job titles and role descriptions and profiles, because it's becoming so important. Lastly, my third theme is how the working capital environment is changing, and ultimately there are both positive and negative aspects to this, both challenges and opportunities. From a challenge perspective, we've got the prospect of increasing protectionism with the current political backlash against globalisation. And this could make it much more difficult to manage global supply chains, supply chains which have in past decades become so interconnected. We're also seeing, as Stephen has raised, the prospect of inflation and increased cost across the supply chain, with an understandable reluctance to pass increased costs down to customers. We found that among our customer base, many importers have hedged, but there's a fundamental challenge that you can hedge against short and medium-term movements, but not against structural changes in a currency. And many of our customers are quite taken aback by the severity of sterling's fall and the rates they can actually hedge against. There's another challenge, also linked to profitability and returns issues among the banks. What we're seeing is banks are deglobalizing, focusing much more on domestic or regional markets where they have competitive advantage, and there are ultimately now a few global banks left. And this makes managing working capital in multiple jurisdictions much more difficult. I was talking to a treasurer the other day who has a global instance of an ERP and a treasury management system, but they now have to manage across many different banks rather than a couple of banks they had to previously. So it sort of changed the dynamics of managing cash across border. Finally, there are also more positive changes. I'm not going to say too much about this technology environment, given that Richard is our resident guru, but from a general perspective, technology in the banking and working capital space is moving at a dizzying pace. We're seeing the move away from cash. We're seeing new regulations such as Payment Services Directive 2, which compels banks to open APIs and data channels to third parties. And many commentators are talking about this being banking's Uber moment, that disruptive technology will consign banks to being payment processing utilities. Now, whether you think this is true or not is an area of subjectivity. What we're sure of is that digitisation and automation is a huge challenge and also an opportunity for banks. What we're tending to see now is a developing culture of cooperation and collaboration between banks and fintechs working together. And in terms of why this is important for working capital, it will change how we pay and receive money and how we use money. And it will change how we use data across the supply chains, and it will change how ultimately connectivity and efficiency is driven across the working capital cycle. It will make things easier for customers and for users, whether you're corporates or consumers, retail customers, and ultimately give you more choice. So on that canter across three broad topics, James, I'd like to hand back to you.
Thanks so much. That was excellent. Brian, I think your turn, probably more from the user perspective this time.
Yeah, thanks, James. I just want to make a few points because 2016 for me has been a very interesting year, because at the start of the year, lots of people were saying to me, well, surely in an environment of negative interest rates, more and more corporates will not be interested in having working capital programs. The interesting thing is exactly the opposite has happened. And a lot of that, we've heard statements from everyone of us so far about anxiety, about Brexit, about Trump, about the Italian referendum, and so on. And there's many more things to come. We have elections coming up all through the year, which may or may not have predictable results and fallout from that. So, and one of the things I've always observed is that in a climate of anxiety, we get indecision. Now, personally, I've seen this in two completely different forms. Yeah? One is that more and more people are starting working capital programs, not necessarily kind of top-end aggressive programs, but everyone's keeping an eye on this one. And the second thing is that if we look at hiring decisions, CapEx decisions, lots of people are delaying decisions. It's not that they eventually won't make them, but they're waiting until the environment kind of settles down a bit and we all understand exactly what might happen. For instance, with the Trump administration in the US, we, in many senses, don't really know what's going to happen. And we're just going to have to wait and see. The other interesting thing then is that if you look at the working capital programs that I've seen kicked off this year, there's two themes that I'm seeing. One is it's far more common now that the person who's responsible for treasury is the person who's tasked with running the working capital program. Now, this has always happened to some extent, but it's a much, much stronger trend. And I think this is another reason for anxiety, because treasurers usually know everything about funding and cash management and all this kind of stuff, but they're not necessarily trained in the operational workings of the business, nor usually do they have the power to actually tell all these folks in procurement, sales, and so on what to do. So that does cause a problem. I think the second thing is around there's more tools to be used. So there's the traditional things of changing payment terms and be better at collections and so on. We've even had supply chain finance products and dynamic discounting and et cetera, now around for many years. But not to kind of steal the next bit, but the fintech piece is starting to create a revolution. Blockchain is probably the biggest evidence of that coming over the horizon. I have to say, in my experience so far, it's probably been more talked about than it's actually happening. But it's one of those things, it's certainly not going to get reinvented. And I think, the other thing that resounds with me right through this year is an old friend of mine used to say to me that the person with cash in his pocket always has options. And I think that's why we're seeing another year where cash balances of major corporates continues to grow. And this is the next year, about 7 or 8 years in a row this has happened, where, again, logically, this shouldn't be happening. But I think it's a reflection of just people are afraid of what the landscape is to come. James?
Fabulous. No, thanks very much. Right, Richard, I think your turn. The IT dimension, the tech dimension to all this.
So I've been asked to give a little bit of insight into 3 things. One is innovation, another is digitisation, and then new technologies or emerging technologies. I'll take those 3 in turn. The insight I'm drawing from comes from our scouting teams out in San Francisco, where the majority of what is described as fintech, venture capital and investment is certainly the activity is going, followed by London, then Tel Aviv, and then onwards into Berlin. And that's then backed with a number of research teams. Those have published, and certainly on the website today, you can take away some papers around blockchain or distributed ledger technologies, we tend to call them, APIs and payments. And then last but not least, the labs that we have taking the shrink wrap off some of these emerging technologies and making sure that we understand the difference between the hype and the reality. So if I focus on innovation first, the growth of the fintech industry and the venture capital investment in there topped $19 billion in 2015, was expected to grow in 2016, but the FOF has come off that as we've gone through the year. What we have seen over the last 2 or 3 years is an explosion of financial services or fintech apps being delivered. That's now gone from sort of 30,000 to 70,000 over the last 2 years of these apps coming into things like the Apple iStore, but targeted specifically at financial services. And as we see the saturation in the retail space, the fintechs are starting to move towards other areas of financial services, and you should expect to see them delivering apps into your space relatively soon. Digitisation, and we've defined that because it is quite an overloaded term as merely the relentless reduction of paper in your processes. And what we then recognise is having reduced that paper and having stored all of this now as data, you want access to that data, and that is certainly becoming a big theme of digitisation. It isn't just the relentless reduction, it's also the access to the paper that we digitised. And that's very obvious. We can see that in things like our cheque volumes have now halved in the UK over the past 5 years, and we will expect them to halve again over the next 5 years. We've now broken that magical halfway mark where all new loans, half of all new loans are online rather than face-to-face or paper. And you can start to see that we are now looking at laggards rather than early adopters in that digitisation process. I.e. the revolution is not finished, we've certainly started it. And then lastly, on the new technologies, I think the takeaways that we would want you to focus on, or the trends that we certainly are seeing around the artificial intelligence space, where we have now seen all of the big technology firms, Google, Amazon, Facebook, and Apple, deliver a human interface or mimicking human interaction through voice, and we would expect that to grow into the financial services industry rapidly, mostly around customer service rather than sales. If I separate what we call machine learning, which in layman's term is effectively forecasting or predictive analysis, we are starting to see a huge investment in that space, and that will probably be 2017's next big theme, as the annual investment of that has now already exceeded $2 billion a year. Already mentioned on the webinar the current theme that is inside the tech industry around blockchain. We, as I say, describe this as distributed ledger technologies, where blockchain is merely one of a broad family of technologies where you are trying to get consensus on a common piece of data. And although the experiments and the proof of concepts have been going on now for over 18 months, the recognition that there's only so much fun you can have on your own with a blockchain is moving most of the participants into consortiums so that they can collaborate, because we would expect the technology to mature over the next 2 to 3 years, and those consortiums and collaborations to yield working systems that reduce mostly a target cost efficiency. But at $16 billion investment to date in that theme, it isn't going away. It is only going to get bigger. And we lump in with that the emergence of digital currencies, separate from blockchain and distributed ledgers, but digital currencies should not be forgotten. They are a growing technology theme. And then last but not least, in that new technologies bucket, or the emerging technologies bucket, we would describe the use of services on the cloud as a growing phenomena, which you almost certainly are already doing, but that has a long way to go in terms of growth, where you are switching away from the use of your own proprietary systems and your own in-house systems and moving those to cloud-based provision. The APIs or interfaces are not new in your areas, and it's certainly not new to financial services, but with a new name of API rather than interfaces, you're now going to see an API economy grow as people open up their data and new products and technologies start to use that data in different ways. So that gives you a round trip around innovation and the fintech industry investment, digitisation and that relentless reduction in paper, and then lastly the emerging technologies, where I gave you a few to investigate, which I think will be arriving on your doorstep relatively soon. James, I'll pass it back to you.
Richard, thanks very much indeed. That was I think, an excellent overview. Right. I think the first question we've got is really sort of about Treasury's role in the business, and worthwhile just looking a bit more deeply into with the increasing importance of working capital, do companies need to reassess Treasury's role, and indeed expanding that a little bit further, what should treasurers be doing to make sure they are able and capable of stepping up to the plate? Who wants to kick off?
I think my experience, James, is that more and more CFOs are kind of thinking working capital funding, therefore it's the treasurer. Yeah. And that's very traditional, and I think that's absolutely correct. There's the other side of it, what I call the process side of it. So how do we change the way our sales force interacts with customers? How do we change the way procurement operates with suppliers? How do we change the way the rest of the finance organization operates and so on along these processes. How do we change the way our production colleagues manage inventories and where they have it, don't have it, and so on? And the two challenges, as I said, is one, the general background of most treasurers is not in procurement and not in procurement and not in manufacturing. And the second thing is that even if they do come from, let's imagine they come from all those different backgrounds, in the corporate structure, they don't have the political power to tell people what to do, which means that they either need to come with the backing of their CFO and possibly the entire board, or they need to do lots more day-to-day negotiations with people, try and get them to do things which ordinarily they might not think were important or understand were important.
I agree with that completely, and I think it's happening already to an extent. So if you look at the evolution of Treasury since the 1970s and 1980s, from being sort of a pretty dry accounting function that was hidden in the ivory tower of the finance function, it has changed, and it is much more involved in the business. And it's now about how to take the next steps of being even more interactive with procurement, with the whole supply chain, which hasn't necessarily been a Treasury task in the past. But as I say, I mentioned that we've seen at the SET conference many more treasurers and Treasury staff being involved and directly responsible for working capital programs, which is sort of a bit of mood music about what we're seeing about the growing power and influence of Treasury to focus on this stuff, which is really genuinely important.
And just following up on one of the sessions I was involved with at the recent physical conference, how many companies, or what's the trend within companies to actually sort of measure performance or actively measure performance on working capital management, as opposed to it's just a number in the monthly management report and we sort of carry on?
Well, I have to say, James, this is one of my pet bugbears through life, because if you think of it, we have literally spent trillions across the world on ERP. And as a result, we're able to produce all these transactions and so on at volumes that would be unthinkable 20 years ago. The problem is that very few people have any decent reporting on it. Of course, we have a profit and loss in the balance sheet and all the statutory things that we have to have. But very often when I look at deep-rooted working capital reporting, what's going on, cash flow forecasting, all these things. As we saw at the conference, most people actually admit that they're still using spreadsheets for this stuff. Which is really deeply ironic and sad, given that there's been this huge investment in the basic transactional system, but we don't necessarily always have the reporting. Now, there's a few companies that have done this well. A few. But it's a very small minority. And I think this is the other area where fintech, like our friends in Cashforce and people like that, are stepping into these vacuums to try and create solutions around this.
It's also how you embed performance dynamics. So if you have a sort of a corporate target, aspirational corporate target around working capital and free cash, but it's not then embedded in behaviours around your sales function, your procurement function, down to how people actually operate. You have to embed it in people's targets and incentives. It's not going to work.
And I suppose just thinking sort of slightly bigger, if your target is EPS, potentially EPS is not necessarily affected by the levels of working capital in the business. There's got to be a cash driver there.
There is a relationship, but it's fairly indirect. Probably the simple way of expressing this is if you're a sales manager and you keep on missing your sales targets, you will not be around for a long time. If I'm the same sales manager and I keep on missing my day sales outstanding targets and my due targets, I'm probably going to get away with it. Now, that's an unfortunate fact of life. I could flip that into procurement or manufacturing, whatever. I produced everything at the right unit cost, but hey, you know what? I had too much stock. People don't get fired for those things. And in the finance world, particularly the quarterly finance world, it's all about EBIT. It's all about revenue targets. It's all about growth. They're the normal bits of language that we hear. I think what has changed on this is that what I call the clever analyst questions. Have a habit of sometimes just dropping in that question about cash flow from operations or something like that, which if you actually listen to a lot of analyst calls, as I sadly do sometimes, you find can be answered extraordinarily blandly and badly.
Absolutely, and it's a real indicator of operational efficiency. Is the business driving out true efficiency? through working capital, which sort of shows the underlying health.
And again, and also by implication, you're starting to get analysts sort of probing management's grip on the business and grip on the business and what makes the business generate value for its investors, rather than necessarily just a headline accounting number.
Absolutely, and when we've seen some acquisitions where the acquirers come along, often VC-backed, made an acquisition and stripped out value by focusing on working capital because they haven't been focusing the business in the past. And that's
I remember working with one where they were acquired by another company. It turned out that their working capital to sales ratio was 37%, which is extremely high, which was entirely down to their manufacturing process. They manufactured in 8 different locations all across the world. So basically, you have all this working process moving around. Very expensive stuff too. So when they finally clocked it's working capital because of the manufacturing process, rather than knock everything down and rebuild it all in one factory in one place, which would have been the solution, they said, that's too much investment, so they sold the company. Now that's a classic case of they became aware of the working capital issue, but at the time of acquisition, they weren't at all. That happens time to time.
And I think the danger for companies is that working capital only becomes a priority or an issue almost when it's too late. You need to get in ahead of the game.
Yes, and the other problem as well is I have one case, live case, with a non-exec director who's asked a question about, again, an acquisition, where the acquisition's working capital sales ratio is 16%, pre-acquisition business 7%. So it's natural that someone should ask some questions. But unfortunately, this person doesn't really know what they're talking about. So they're trying to offer some extremely, what I will call, glib solutions, which just show that they don't really understand the nature of the business that they're supposed to be supervising.
Okay. Turning to sort of more the macroeconomics, sort of one for Stephen here. With weaker pound, potentially higher in US interest rates, higher commodity prices, particularly oil, and combined with the UK's position as a net importer, this kind of all points, certainly from the UK's perspective, to a balance of payments deficit. How much longer do you think the Bank of England will be able to continue its lower for longer position? And I guess for the collective, what's the implications of that for working capital management? So Stephen, your thoughts on lower for longer?
Okay. So we'll definitely see building inflation through 2017. The Bank of England's clear that it is prepared to tolerate inflation that is above the 2% target, as long as it does not begin to rise too rapidly. Their most recent inflation report forecast envisages that inflation in about a year's time will rise above 2.5%. And they have said that they are prepared to accept that they think the cost in terms of lost output and higher unemployment of raising rates to try and bring inflation back to target, that's a cost that they are not prepared to pay, and it's not a price worth paying. So my expectation is that the bank rate remains where it is for some considerable time yet, certainly through 2017. The only reason that it would be raised is if in response to higher inflation, we in the United Kingdom pushed for much higher wage rises, and that led to much more quickly rising domestically generated inflation.
Okay. And then
on the whole lower for longer issue, I think the important point is to reiterate what I said earlier, that the reason rates are low is partly because what central banks are doing, but much more so because of these deep structural changes in Western economies, which are pushing down growth and pushing up the demand for saving and down the need for investment.
Right. Stephen, thanks very much.
Just wondering, Stephen, on this point, do you see any analogies with the 1960s, where in Britain you had low inflation, high balance of payments deficit, which ended up in a massive currency devaluation?
I suppose the big difference, or a big difference between now and then, is that during that earlier period, we were operating internationally with a system of fixed exchange rates rather than floating, which meant that there were intermittent crises when governments tried hard to defend currency values through capital controls and interest rate changes and so on, and then eventually had to give in to market forces. What we've seen this year in particular is that currency adjustment can do much of the hard work that was previously done in those different ways when exchange rates were fixed.
Yeah.
Just on the inflation side, I mentioned it briefly, but the concern is inflation feeding through into supply chains. What we've seen among our customers is a real reluctance to pass it on to the end consumer. So no one's doing it yet, but once the first mover jumps, then everyone else is going to have to follow. So we see it is going to happen. And that's the big challenge we're going to have with inflation, I think.
Sure.
Yeah, and I think that the lower down you are the supply chain, the more you're going to suffer from that.
And do you have the opportunity to actually change your supply base to be more domestic and sterling focused? Well, theoretically great, but practically it can be quite difficult.
Yeah. And for me, the sort of brings a new dynamic in, doesn't it? Because we've seen how corporates in particular are constantly focusing on hoarding cash, but if you've still got really low interest rates and you've got inflation at 2.5%, 3%, the cost of holding that cash starts to really become, very material indeed. And then I think that in a year's time we may find that the dynamic has moved on again.
I would say that's always a potential, but you know what? I've been hearing since 2009 to say, interest rates are going to go up in the next year, and it hasn't happened yet.
Yeah. So you should see.
And I agreed with all the predictions at the time, so I was as wrong as that.
Okay. Right. I'm afraid the time has come to wrap up. I'd like to thank our presenters, Stephen and Richard, who are dialing in remotely especially, plus Rowan and Brian here at the ACT. I'd like to thank NatWest very much indeed for their support, and I'd also like to thank everyone who joined today's session. I'm sorry if we didn't reach your question in time, but as I mentioned at the start, we'll be uploading a recording of this webinar on the ACT website, along with the presentations in a couple of days' time, and we'll send you the link. Very briefly, looking forward to 2017, we've got physical events coming up, Smart Cash in London in February, the ACT Europe Conference in Düsseldorf in March, and the ACT Annual Conference in Manchester in May, as well as training events in April as well. Thank you all very much for listening. If you can spare a moment to provide feedback on the webinar, we'd be very grateful. Please select the feedback widget, which is in green at the bottom of the screen. The facility to do this will remain open for a short while after the webinar ends. From all of us here, thank you and goodbye.